here to weigh in on what these data points signal for the economy is Bill Adams, Comerica Bank chief economist. Bill, great to have you here with us. So a lot of data points to really wade through on a Friday, a summer Friday at that, but yet many of them telling about where the trend of the economy is moving as well here. What do you give the most weight to here this morning?
Hi, Brad. I think the message from this morning's data is that the economy has downshifted in the first half of this year. And that's, I think, why consumers are feeling a little more downbeat in early July. Even though inflation is slowing and the consumer survey showed that consumers are also seeing lower inflation and expecting lower inflation, consumers don't see as much, as rapid growth, are not as upbeat about overall economic prospect. And the Fed's high interest rate policy has definitely slowed the economy in the first half of this year, and that's affecting the outlook.
How much slowing do you think the Fed needs to still see for that rate cut, the first one, to finally come through?
I think the Fed just sort of needs to see the economy holding where it is right now. The real GDP in the first half of this year, I estimate, it's a little under 2% annualized. And I'm expecting this pace to hold in the second half as well. And with that, there's a little margin of slack that's open in the labor market. Unemployment rate's back above 4%. Inflation is moving lower, kind of 2 steps forward, 1 step back. And that's the mix of data and economic conditions that the Fed wants to feel comfortable cutting interest rates. They're not going to cut them down to zero overnight, but I think the outlook is for gradual reductions over the next 12 to 18 months.
And of course, as we kind of compare and contrast CPI and then the latest data out of PPI, it's still very telling about where there is more spending on the services side versus goods, and particularly on the production side here in the data that we got here today. Wondering your read through there.
It's a little bit mixed messages from yesterday's CPI to today's PPI, where we saw actually one of the big price increases in today's PPI report was retailing margins on autos were up in June versus May, where actual prices of new and used cars were down month over month in yesterday's CPI report. So to my mind, that suggests that we could be seeing some of those car dealers holding on to some of the margin as prices come down at auction, and that helping the car dealers in the middle of 2024. Although this was also a really weird month for car dealers. There was the CDK hack that held back auto sales last month. So I think the big takeaway from the inflation data is that core inflation, both by the CPI and the PPI, is a little over 3% year over year terms, which is not 10%, it's not 5%, but it's also not 2%. And so inflation's back close to normal, but not quite down to where the Fed wants it to be. And that to me says July is too early for a rate cut, but I think September is very much on the table, and I think there's good chances that the Fed will reduce rates at their following meeting in September.
Looking at some of the context that it came in with today's consumer sentiment reading, there's one note within here saying that nearly half of consumers still object to the high impact or the impact of high prices, even as they expect inflation to continue moderating in the years ahead. And they also went on to mention with the upcoming election, consumers perceive substantial uncertainty in the trajectory of the economy, though little evidence that the first presidential debate altered their economic views. How much does the election have an overhang on consumer sentiment and consumer spending patterns?
It's typical in election years that you see uncertainty rise. You see that in consumer surveys and business surveys. A lot of business surveys now are showing that heightened uncertainty is increasing expectations that businesses kind of kick the can down towards the end of the year about big decisions, waiting to see what the election bears. And typically after the election passes, businesses sort of adjust to the new reality and things return to trend. So that may be a bit of an effect on consumer spending, business spending over the next 6 months. Really hard to judge the magnitude of it. But in general, what we see over the last year, 2 years, 3 years is a big disconnect between what people are saying versus what they're doing. Consumers are saying they're really downbeat on the economy on the one hand. On the other hand, spending on travel and tourism and recreation is still going really strong. So I think the economy is holding up pretty well this year, despite the headwinds of high interest rates. I think the risk of a recession in the next 6 to 12 months is pretty low, and net, this is a pretty good economic backdrop.
Yeah, net, you say you're upset about this, but I've seen your Instagram stories, and it seems like you're still out there in these streets. Bill Adams, Comerica Bank, Comerica Bank Chief Economist. Great to have you here with us this morning.
Thanks for having me.
Certainly.